You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen, and it's the 8th of December, 2022. In this week's episode, we'll be discussing British American Tobacco, Supreme, AJ Bell, Mind Gym, easyJet, and our US company of the week is sfix. John, shall we start off with a favourite of the show?
Well, yeah, we certainly cover it a lot. It's British American Tobacco, the UK's largest tobacco company, who released their full year pre-close trading update today with full year 2022 guidance of revenue growth of between 2 and 4% at current constant currency rates and mid-single figure adjusted diluted earnings per share growth at constant currency, including a transactional foreign exchange headwind of around 2%. Full-year global tobacco industry volume is expected to drop by around 2% rather than the 3% previously forecast, driven by the continued post-COVID recovery in the emerging markets. Net finance costs are now above £1.6 billion, driven by the rising interest rates and the US dollar's strength. And of course, the group had taken on a significant amount of debt when they purchased Reynolds a few years ago. There's a translational foreign exchange tailwind of around 7% on adjusted diluted earnings per share growth for full year 2022. And the full year operating cash conversion will be in excess of 90% of adjusted profit from operations. The group expects leverage for the full year at the high end of the corridor of between 2 and 3 times adjusted net debt to adjusted EBITDA, with the current exchange rates until the end of the year. In terms of views, the group's e-cigarette, it continues to make progress with the global value share up 2.2 percentage points September year to date versus full year 2021, reaching 35.7% in key vapor markets. Views also extended its number one position in the US as the most popular e-cigarette in 35 states and total vapor share of nearly 40% in the country, which is up nearly 7 percentage points compared with full year 2021. The new Vuse Go, which is a disposable vape, is now number 2 in the UK and France by value share, and it's recently been rolled out in 12 markets. Coming on to Heat Not Burn, Glow has gained volume share in key markets, up 1.6 percentage points to reach just under 20% of the Heat Not Burn market. In Europe, Glow has a 20.4% share by volume, and that's up 4 percentage points. In Japan, Hyper drove Glow's total nicotine volume share up 50 basis points to reach year-to-date share of 7.3% and total volume share of 20.2%. That's down 1 percentage point in what is a very competitive market. Fellow, the group's oral tobacco or snus, continued to lead in Europe with a volume share of nearly 70%, although category volume share in key oral markets was 30.6%, which was down 4.1 percentage points, with a fall in the US as the group continues to prioritise investment in the much larger vapor market. On to traditional combustible cigarette. The group's cigarette value share was flat September year to date, with gains in the US and Asia Pacific and Middle East, offset by the Americas and Sub-Saharan Africa, and Europe declines. They continue with strong pricing only, partially offset by mainly a geographical mix. And there was continued value share growth in the US, up 10 basis points September year to date, driven by the group's premium brands. US industry volumes are expected to reflect increasing macroeconomic pressures observed in the second half. In terms of valuation, British American Tobacco has a market cap of £74 billion and trades at just 8.5 times forward earnings, compared with a 10-year average of just under 13, and it yields a whopping 7.3%. I thought these results were fairly decent. They didn't really move the dial very much, I wouldn't have said. I think what we've commented on before is that we've been impressed, or very impressed, in fact, with the revenue growth of those next generation products, particularly in the US, where it's number one with its Fuse brand, and those traditional combustibles, which have the highest margins, have been gradually declining. I think we're really seeing that again in these most recent, or this most recent update. I guess one thing that's becoming a little bit more concerning, or a little bit more apparent, is the level of debt that the group is carrying, and that's largely as a result of that big takeover of Reynolds Tobacco a few years ago. Obviously, interest rates were much lower then, and it made quite a lot of sense for the group. But you are seeing that now with the net finance costs of above 1.6 billion a year, not at an unaffordable level, but it is growing. I suppose one other thing that might be worth mentioning as well, and again that leads on from the Reynolds acquisition, is that they've got the Newport brand, which some people know as the prison cigarette, but it's most of the sales of Newport are menthol, and there is increasing regulation in the States with the menthol cigarettes, and they have been banned in some states, including California. So that is something that we may see feeding through if it spreads further. Other than that, I would say that it was sort of business as usual and still fairly decent. Again, if we compared it with Imperial Brands, which I'd have to check at what it's trading at right now, but has been a little bit cheaper, you've got that, I suppose, potentially more of a future in British American Tobacco, looking at how well they seem to be doing on selling that next generation product. It does seem to have a strategy going forward. Is perhaps less true of Imperial Brands, but they're both trading at very low valuations. Sam, what are your thoughts on these results?
Pretty similar. Is this just a trading statement?
Yeah, it's just a trading.
Yeah, I thought so. So yeah, I mean, the figure I always look at is the non-combustibles growth. I don't think they've given that. They have said they've added another 3.2 million consumers, reaching 21.5 million now. So that suggests it's going to be pretty decent. I thought it was it's just the non-combustibles. That's what I like about it. I agree it's very cheap. Same as last time we covered it. I think the dividend's very good. Very defensive stock at the minute, which is reflected in the increase in the valuation recently. I think it was interesting. We got to see some of the heat not burn, didn't we? We tried that a few weeks ago. We got to have a go on it because you don't see them here.
We were in Poland, actually, so sort of Central Eastern Europe, and we were in a bar, and we were approached, and then we saw the lanyard that these two young girls were wearing, and it was British American Tobacco. They wanted you to have a puff away on one of their e-cigarettes. Well, no, actually, I should clarify. It wasn't an e-cigarette. It was one of the heat not burn devices. It was one of the glows. So we did say that as part of our podcast, we'd been getting the updates from British American Tobacco, and we'd seen the progress, as it were, of Glow. They seemed quite confused by this.
They were like 16. They were very young as well. It was quite.
Yeah.
It was like probably like 16, 17-year-old girls.
Just
going around selling heat not burn tobacco, which you don't get as much over here.
You certainly don't. And I mean, all in the British American Tobacco sort of gear, but it was, I think it must have been at least 3 bars that we've been in over the course of the trip that we saw them active, going around to every table promoting them. I guess you're seeing that reflected in some of that growth in those key markets, and sort of Central Eastern Europe being some of them.
Shame they can't do that over here, isn't it?
Well, yeah, I think the regulation must be more lax there, because I can't imagine it would ever be allowed over here. But it is very interesting. And they seem to be selling those products in all of the corner shops as well. They probably do here, but I guess I just shop more online, so I don't see it so much.
Yeah. Shall we stick with our tobacco theme then, or nicotine?
Well, loosely. I mean, Supreme is more than just an e-cigarette company, isn't it?
It absolutely is. And I will start with that. So for anyone who didn't, we've only covered this stock once before. It is a stock that I own, I should add. But for anyone who's not familiar with the business, I'll keep this very brief because some people have already heard a bit of a monologue last time. But Supreme supplies products across 5 key categories: batteries, lighting. So they've got like the licenses in the UK for like Duracell and some of the well-known lighting brands. Vaping, they have a 30% market share of the UK vaping market, and that's at the lower end of the market. So it's the lowest price. So it's 88 Vape is the brand, and you'll see adverts on the back of buses and stuff like that. Sports nutrition and wellness, and branded household consumer goods. The group has over 3,300 active business accounts with retail customers who manage over 10,000 branded retail outlets. Customers include B&M, Home Bargains, Poundland, The Range, Sports Direct, Londis Spa, Costcutter, Asda, Halfords, Iceland, and Her Majesty's Prison and Probation Service. In addition to distributing globally recognized brands such as Duracell, Energizer, and Panasonic, and supplying lighting products exclusively under the Energizer, Everready, and JTB licenses across 45 countries, Supreme has developed brands in-house, most notably 88 Vape, and a growing footprint in sports nutrition and wellness. They have come out with their half-year results, and revenue was up 6% to 64.6 million. They said that's supported by outstanding performance from vaping category, mitigating one-off declines in the lighting category. So we touched on this last time. They normally do a very good presentation that they put on YouTube where it's like an hour Q&A going through the figures with the CEO and CFO. I haven't watched that yet, but based on what it was last time, in lighting, there had been basically a complete dry up in the light bulb market. A lot of people were over purchasing in COVID, they said. I think it's because they were at home. So, they'd have a drawer full of light bulbs, and if one went, it'd go. And then what's happened is now, because we've got inflation, recession potentially, or I don't know if we're in recession or not at the minute. But anyway, with the economic climate, if you've got a drawer full of light bulbs, you'll just let it wind down. If you've got one light that's gone, you might wait for it to be 2 or 3 if times are a bit tougher. So basically, and what had happened was, a lot of the retailers had expected the good times to continue, and they'd massively overordered. So they just slashed their purchases for a while whilst they let the stock die down. So they've taken a big hit for that, and it is a big one-off hit. So for me, that revenue increase of 6% is very good because it's actually reflecting much better figures than that. Because what's happened with the lighting is actually a bit of a one-off. Year to year, as you might imagine, in the UK, we sell a pretty similar number of light bulbs as we did last year. So these brands are basically going to bounce straight back next year. So they've said there was a 47% increase in the vaping category, fueled by organic growth and bolt-on acquisitions. And they've said lighting is now starting to recover. There's solid revenue growth of 19% for sports nutrition and wellness and 5% for batteries. Gross profit margin was 28%, and that's down from 30% a year ago, but that's just due to the change in sales mix. They've highlighted they've got a strong balance sheet and an optimal allocation of working capital. Interestingly, the net debt has actually worsened compared to a year ago by 133%. However, it's still it's still pretty low. So it's 19.6 million now, and that's been used to fund acquisitions, and that's on a market cap of 116 million. And I'll just get the financials. The operating profit last year was 17 million. So it's 1 times operating profit, basically, one times last year's operating profit, which pretty low, actually. So I'm not concerned about that. Earnings per share is down 52% to 2.8p a share. Profit before tax is down 48% to 4.4p a share. And the dividend is down 64% to 0.8p a share. For me, the main figure is the revenue growth. A lot of that's then being reinvested. I'm not really concerned about the dividend being slashed. They'd announced they were going to do that. And the reason is because they're looking for these bolt-on acquisitions they can do. And there's no point. Basically, they think they've got a better use for the capital and distributing it to shareholders, which I'm more than happy with. Operational highlights. They've completed 2 strategic bolt-on acquisitions within the vaping category, which I'll talk about a bit later, delivering incremental adjusted EBITDA. The Psy MX brand, which is part of the nutrition, is now delivering encouraging sales and momentum, with the demand for protein supplements, particularly powders, growing. Lighting category is now stabilising, with early signs of recovery in retail sales likely to be reflected in financial year 2024 orders. And they've signed a 15-year lease on a new warehouse facility in Manchester, capable of housing much of the group's manufacturing and distribution activities from one principal location. They said they've had a positive start to the second half, with trading now ahead of market expectations for the full year. Vaping category is expected to deliver a robust performance in the second half, reflecting positive impact of both organic and acquisitive growth. The business continues to navigate global trading challenges arising from raw material cost price increases and inflationary increases to its overhead base. The board remains confident in the future growth prospects for Supreme in the medium to long term, with the group focusing on generating organic growth whilst fully integrating its recent vaping acquisitions. So they've given a breakdown of each segment in the results. I'm just going to go through the vaping one, just because for me, that's one of the most interesting things about the business. They said, our vaping division delivered exceptional performance underpinned by strong acquisitive and organic growth. Revenue grew to 31.8 million, and that's up from 21.7 million a year ago, a substantial increase of 47%, while the gross profit margin has reduced to 38%. This is due to a change in the sales mix, with consumers purchasing a higher proportion of disposables and pods sourced from the Far East, where margins are lower. We enhanced our market position by securing additional distribution across the grocery, discount and retail spaces, further increasing our UK footprint. After extending our contract in the first half, we further increased our penetration in the prison market in the period, providing a greater range of bespoke vaping products to facilitate safe and controlled vaping within the prison system. We completed the immediately earnings-enhancing acquisitions of Liberty Flights and Cuts Ice and Flavour Core, which constituted 3.4 million of the division's revenue growth, 16%, with the remainder of the growth 31% arising organically. Pleasingly, we've successfully integrated the Cuts Ice business into the group within 3 months of the acquisition. There has been a strong interest in Cuts Ice from retailers and distributors since the assets were acquired. Given the business's European platform and its extensive manufacturing and flavour development operations, the rapid integration was a significant achievement and presents a sizable commercial opportunity for the business. The continued expansion of our product offering is generating additional cross-sell opportunities, with the ongoing demand for our 10ml Hero product from the 88 vape range driving increasing rates of return. As the demand for disposable vaping products continues to rise, we focus on enhancing our existing product offering with the launch of new 88 vape disposables in July 22 and a Zillion Plus disposable nicotine-free range in September 22. Simultaneously, the acquisition of Liberty Flights, which predominantly operates in the pod market, has enabled us to establish a foothold in the closed system vaping market as well as convenience retail. Interestingly, for the 88 vape disposables, so you can get them on the website. It's quite similar to what they do with the nutrition, where you can get them and they send them to you. Very little packaging, very little sort of on the thing. The lowest cost operator. I had seen the adverts for these in like service stations and places like that. So I did actually order some online because I do quite like a vape on a night out, and I have to say it was basically exactly the same as the Elf bar, but just half the price. And I did quite like the little 88 on it and supporting Supreme. So I won't be a very frequent customer because I don't smoke, but I have done my little bit of market research there, along with trying the heat not burn in Poland. In terms of the valuation, including the 52% drop in the earnings in this half, it is trading at a P of 11.6. And that's for a business that has grown revenue in the past 2 years from 92 million to 130 million. And you've got the vaping segment inside it, which is growing very, very well. As a shareholder, I'm very happy with this. I still need to watch the presentation video, which I will do at some point in the next few days, but I'm pretty happy with these results and the valuation. I'm very happy with how the vaping section is doing. John, what are your thoughts on these results and the valuation?
I mean, it certainly is a very cheap valuation for the track record that it's delivered, and it's in a growth market of vaping. I guess if you were to be critical of it, or if you were to sort of put the bear case forward, I guess if there was any sort of radical change in the regulation of the market, and from a public health point of view, that could seriously impact on Supreme. And the other thing, I suppose, with it being such a small company and the majority owned by the current chief executive, there's that sort of governance side of it, which possibly depresses the valuation somewhat too. But if you're looking for a growth stock in the UK, which is a small cap, I mean, Supreme is delivering that for sure, and it's not expensive. Like you say, there's a case to be made for investment in Supreme. I guess one of the only things, and people have lots of different views on this, is what you think about the ethics of e-cigarettes. But that would be all I'd have to add on it, really, Sam.
My view, to counter the two main issues you raised, I think the CEO, you need to keep an eye on it. But he is on the calls, and if you watch a few of those, you can get, I feel like, quite a good idea of his personality. I like the way he comes across, and I don't think there's anything he's done where I thought, well, that's ridiculous. But the issue is, if at some point he does decide he wants to do something ridiculous, like John points out, you can't really stop him. But so far, I like the way he's come across. Whereas if he'd come across differently, it's like, well, I'm not sure about this guy. That would be much more of a concern than it would be with a regular CEO. The other one was the regulation. I understand the point, and I do agree with you, but I don't think we're going to see that in the short or the medium term. I think there's going to be more of a push to try and encourage the e-cigarettes, if anything, just because whilst they're not great for you, they are a lot better than smoking. I mean, it's just, I know we still don't know the long-term effects, but I'm not a doctor, and you might tell me as a doctor, this is rubbish, but I just think if you're breathing water vapor into your lungs compared to actual smoke, it's pretty obvious which one is worse. So I'd be surprised. I'd be surprised if they started increasing the regulation at the minute, because it's still growing. And I think they'll want that because a lot of that growth is going to be coming from smokers. You've also got the flip side, I guess, if you're playing devil's advocate, where you say, well, how much of that growth is actually from like 18-year-old girls on a night out that never would have had a pack of fags? But yeah, I'm not too concerned about that.
And it's interesting politically because in the UK, strangely, there seems to be more of an emphasis on the harm reduction argument behind e-cigarettes than there perhaps does in the US, which I think with a lot of issues, you'd expect it to be the other way around. But yeah, I mean, that would see how that plays out, really.
Right. Shall we move away from the smoking theme now?
Yes. So on to AJ Bell, which I don't know, it's certainly not a favourite of the show. We've covered it a few times now. It's the DIY investment platform and wealth manager. They had their full year results out for the year ended 30th of September, with revenue up 12% to £163.8 million as a result of higher average assets under management and improved revenue margins despite price reductions during the year. Revenue margin improved 22.6 basis points as higher average interest rates earned on cash more than offset the impact of more moderated direct-to-consumer dealing activity. Profit before tax was up 6% at £58.4 million, whilst profit before tax margin fell slightly to 35.6%, reflecting planned investment in brand technology and pricing to drive longer-term growth. Platform customers were up 16% to 425,652, and net inflows totaled £5.8 billion across both advised and direct-to-consumers, whilst AJ Bell Investments saw net inflows of £1.05 billion and assets under management up 29% to £2.7 billion. Looking at the revenue streams, on the advised side of the platform, revenue was up 16% to £83.2 million, with only £5.4 million of that transactional and the rest recurring. The direct-to-consumer platform saw revenue increase 11% to £68.3 million, despite a 2.2 basis points fall in revenue margin, as transactional revenue fell 21% due to the more moderated dealing activities versus the prior year. But there was an increase in assets under administration and higher interest rates earned on the cash compared with 2021, full year 2021. Distribution costs were up 35% to £15 million, with increased direct-to-consumer marketing, including the Doddle launch, and there was a new TV advert. Technology spend was also up by 27% to £32.7 million, with a 24% increase in average headcount and continued investment in the platform. Operational and support costs rose 8% to £57.2 million, with a 7% increase in average headcount to support the continued business growth. Going forward, the group updated their full year 23 guidance, with the revenue margin on the advertised platform expected to be up 21 basis points compared with 19 basis points previously guided. The direct-to-consumer platform is expected to see revenue margin increase of 45 basis points higher than previously indicated. And the non-platform revenue is expected to be £12.5 million compared with 11.5 previously guided. Full year 24 expects to see no change in platform revenue margins, no material changes to pricing, and base rate changes expected to be less impactful than in full year 2022 and full year 2023, and they hope to continue to scale the platform effectively. Final dividend of 4.59 pence was announced, increasing the total ordinary dividend for the year by 6% to 7.37 pence. And that's the 18th consecutive year of ordinary dividend growth. In terms of valuation, AJ Bell has a market cap of just under £1.5 billion and trades at around 26 times forward earnings, yields 2%. Overall, I thought these results were fairly decent. However, we are seeing costs rise significantly with distribution, technology and staffing 17% higher than last year, and the guidance that they'll rise by another 21% this financial year, and that's bound to hit profits. I'm not somebody who is particularly keen on the industry, and I know Sam and I disagree on this. I feel that it's commoditized and a race to the bottom. But one thing I would say, because I know, Sam, you have Hargreaves Lansdown shares, is that I would struggle to see why anybody would want to pay 26 times forward earnings for AJ Bell compared with 15 for Hargreaves Lansdown. I know there's a sort of a scale difference, and you might argue that there's more, well, some would argue there's more organic growth ahead of AJ Bell. But still, I wouldn't have seen it justifying the difference in valuation there. I don't know what you're feeling. Well, I probably do know what your feelings are, but what are your thoughts on these results anyway?
I agree. There's nothing in there that would make me, as a Hargreaves shareholder, there's nothing that would make me want to switch. What I would say, though, is they are better results than Hargreaves. So these are to 30 September. Hargreaves' last results were to June, and the June ones were not good. So they had quite a decent drop. But that was up against the COVID year. That was mainly why you had a lot of people trading, and it was still up on pre-COVID figures. But Hargreaves did release a trading statement. Oh, in fact, yeah, Hargreaves released a trading statement in October on the quarter to 30 September. So that's probably the fairest comparison. So rather than the revenues being down, they've actually said revenue for the period was up 15%, which was due to the higher revenue on cash. I think that's because of interest rates rising, and also they've started doing cash ISAs. So what are they up? They're up 12% for the full year. So we don't have it for that quarter. But for that year, they might have been a little bit better, but it looks like Hargreaves have now picked up again. Customer numbers increasing, that is a decent increase, but it's still way off. I mean, Hargreaves has 1.75 million customers and they're at 425k, and it's not growing that fast for, I don't think. So they've added 57. So what's that, like 15% or something? It's not huge. And I mean, it's not a business I understand as well because I've only ever looked at it in comparison, like as a competitor to Hargreaves. But I think with Hargreaves, there's a bit more to be excited about for me. And I appreciate what you say about it being a commodity, but I think they are using their scale properly. Like they've started doing the cash ISAs. I think they could do very well on that. I don't know how often you check Hargreaves Lansdown, but when you log in now, they've started in America. They've started doing their own funds. So like you can do their own like equivalent of like an American index fund. They'll charge you like 1%. And I just think they're going to be pushing people towards those first. They're going to be getting all the fees from it. I could see them doing very well from that as well. So they've got quite a few things they're doing at the minute, which I'm quite looking forward to seeing how they flow through into the results. So yeah, so it was the US fund. It launched on the 1st of November. I actually think these are pretty good results if you compare them to the Hargreaves Lansdown 30 June results, but there's still nothing in here that would make me want to switch from Hargreaves. And I think for the price you're paying, I don't think the growth's very good, to be honest. I don't know if you have anything to add to that, John.
No, I mean, I probably, well, no, I wouldn't be buying either. So no, I don't. But if I were to be going for one, it would be Hargreaves, and I wouldn't be comfortable paying 26 times forward earnings.
No. So with that, should we move on to Mind Gym?
Yes, Sam, first time on the show.
It's a debut, and part of the reason because it's not FTSE 350 listed. So it is a bit of a small cap week this week because we've done Supreme and we had a request to cover Mind Gym. I can't remember who it was, but I interviewed someone on the show. He was very, very good who had it in the portfolio. So it was enough that once someone suggested we look at it, I thought I'd give it a go. So it's actually only got a market cap of 90 million. So it's even smaller than Supreme. So for anyone who is not familiar with Mind Gym, which did include me, Mind Gym is a United Kingdom-based business which is engaged in applying behavioral science to transform the performance of companies and the lives of people who work in them. The company does this primarily through research, strategic advice, management and employee development, employee communication and related services. Its solutions include performance management, leadership development, diversity, equity and inclusion, onboarding, personal effectiveness, customer services, and others. Its Performer is an online coaching platform which matches coaches with precision accredited coaches and is supported by psychometric diagnostics and science-backed resources. So they have come out with their half-year results to 30 September 2022, and revenue is up 11% to 26.8 million. If we break it down a bit more, it's split into two sections. US revenue is up 20% to 16.7 million, and Europe, Middle East, and Africa is down 2% to 10.1 million. Digitally enabled revenue is down 7% to 18.9 million. Gross profit margin is up from 85.9% to 87.5%. EBITDA is up 271% to 1.9 million. Cash in the bank is down 62% to 4.5 million. They've also highlighted that, as anticipated, there was a switch back to in-person delivery after COVID, and this meant that digitally enabled revenue decreased 7% on the prior year. In-person deliveries grew from 4% to 15% of delivery revenue. Mind Gym's business model can flex between in-person and digital as needed. Digitally enabled revenues represented 71% of total revenue, and that's down from 84% a year ago. On-demand digital product revenues grew 3% to 2.8 million, representing 11% of total revenue. And repeat revenue remained strong at 87% of group revenue. I didn't actually think there was a huge amount in there that was adding to the results, but there was one slide, and it was called the power of integration to achieve more with less. And there's a bit where they talk about how clients say what they want, and then in their next section where they're talking about creating long-term value, they're saying that this comprehensive source of employee data provides unique value. Software as a service revenue is more repeatable and drives favorable working capital. Mind Gym is the first option for new content because it is cheaper to roll out and contributes to data. And they think they've got significant barriers to entry. So once installed and generating data, it's hard to replace, and it's difficult to replicate without the IP or content. Difficult for a digital competitor to replace us without live delivery capacity. In terms of the valuation, the business trades at a PE ratio of 39. This is quite pricey. It is a small cap. If I look at the last 5 years, I'm not overly impressed with the growth. So it's grown from 36 million to 48 million in 5 years, and you're paying 39 times earnings for that. I've not looked at the breakdown from year to year, so whether US is now the growth story, that might not have been there 5 years ago, so I do appreciate that. But for me, I just, and I mean, the operating profit actually as well used to be a lot higher until the 2020 year, and now it's they've now got operating losses, although they do have earnings again now. So that valuation will actually come down a lot because that's still on the half-year results. If they do a full year of actual earnings, that valuation will come down quite significantly. So it could, in 6 months' time, when they've got full year results out, it could be a lot cheaper than I've said. I'd possibly look at it again when the full year results are out, just see if the valuation's different. But to be honest, I'd need to look at this in more detail. I don't really get the products, and it's not immediately obvious to me why they've got a USP. I find it quite a difficult business to understand, and I just think some of the services they're providing, I don't know how useful they actually are. And I do think some of them seem like when times aren't quite as good, they might, if you've got someone doing like diversity training, it's probably going to be like, it's possibly for a smaller business, for example, going to be one of the first things you cut if the business isn't doing as well, because it might not really be needed unless you're doing it for like regulatory requirements. So I think because of just what the business does, I don't think I'd ever be particularly attracted to it, but I don't think I understand it enough to really, I would have to come back and have a look at this, I think. John, what are your thoughts on the business?
Yeah, I mean, I'd echo that in terms of understanding Mind Gym well, but also it's very expensive. And I'd have thought this would be, for a lot of businesses where we are in the cycle and tough macroeconomic conditions, this would be something that they would cut back on. That would really worry me as if I were to own shares in the company. And I think for that reason, I probably wouldn't even look at it much further than that, to be honest.
I mean, so the thing is, it would have negative earnings based on the last full year results. When you then include this half, it then brings it to positive, because you've got the other half cancelling it out. So that's why I think if we were to come back in 6 months' time, it might be at a PE of 10 or 15 because it'll have that second year. Whereas at the minute, the second half that it's got from last year in the last 12 months, it's a loss. But either way, I still think. In fact, no, it did have some earnings per share last year, but they were very small. But yeah, I think it's too expensive at the minute anyway. But there's really, I mean, the only reason I would come back and look at this, to be honest, is because I can't remember who it is, but there's someone who I know is pretty good who has this in their portfolio.
Okay.
Which suggests we might be missing something. But based on what I've seen from a very, very brief overview, I wouldn't ordinarily come back and look at this. Should we do another business that we probably wouldn't keep coming back to if it wasn't such a good bellwether for the economy?
easyJet, the budget airline, had their full year results out last week, with full year revenue rising from 1.5 billion to 5.8 billion, with the relaxation of COVID rules and passengers returning. Capacity increased from 28.2 million seats to 81.5 million seats, with load factor measuring how full the planes are rising by 13 percentage points to 85.5%. And passengers numbers were up to 69.7 million from 20.4 million. The underlying loss before tax came in at a mere £178 million, compared with a loss of £1.1 billion last year. Included in that figure was a £64 million foreign exchange headwind. Performance was weighted towards the fourth quarter, where operational performance was up on pre-pandemic levels, which was encouraging. Free cash flow came in at £246 million, compared with a £1.2 billion outflow last year. Net debt fell from £910 million to £670 million. Looking forward, management expects inflationary pressures to persist into 2023, with first half fuel prices up over 50%, but note that early bookings into next year look positive, with capacity expected to be returning to pre-pandemic levels. As might be expected, no dividend will be paid. In terms of valuation, easyJet has a market cap of £2.9 billion and trades at a forward price to book value of 1.07, compared with a 10-year average of 1.87. Things are improving for easyJet, with the pandemic rules disappearing. However, it's still making a loss, and a big loss at that. It has to take all of those increased costs and inflationary pressures, deal with strikes, and continue to invest in the aircrafts. I think it also has, again, going back to where we are in the cycle, the prospect of consumers cutting back on their holidays and discretionary spending. So while this is a little bit better, I think this is sort of almost a little bit of sun between the clouds. I don't like airlines. I don't like easyJet, and I think it's in for a difficult time in the next few years. So I'd be staying well clear of easyJet. Sam, anything to add?
I think these results are looking a lot better than the last times we've covered it, and it's still lost 178 million. Which, I'll be interested to see what the results are like if they do get a full year back at pre-pandemic levels. But I suspect they're still not going to be great. It's still got a lot of debt. What I like about covering this business is we aren't just doing it to pick on it. I do find it genuinely a very interesting bellwether for how the economy's doing. So that's the only reason I keep looking at it. I would never invest in this. And the 178 million loss has not changed that.
Okay, great. US company of the week.
Yes, Stitch Fix. which we haven't covered on the show before. It was one of the big lockdown winners. So it's an American company. Right, so how Stitch Fix works. So this is what it says on the website. You tell us about your style. Take a quick and easy style quiz to help us learn what you love. Get pieces picked just for you. Our stylist will send you pieces that reflect your style, fit, and price points, plus expert guidance. Shop on your own in your personalized store. Discover new items and outfit suggestions every day. And then it does say that you can basically, oh, here it is. So you get the expert picks, get outfit and styling suggestions that meet your price preferences, free shipping, easy returns and exchange on all orders, prepaid labels included. My God, that just sounds bad straight away. Based on what we know from looking at Boohoo and ASOS, that doesn't sound good. Spoiler alert. No commitment. Shop when you want, how you want, no subscription required. They actually did used to do a subscription service, so I don't know if they've since got rid of that because it wasn't making money. But they had a service where every month they'd send you 5 items for like $50 and you'd send back the ones you didn't like and you'd only pay for the ones you kept or something, which I don't know if it's gone or not. But they have come out with their first quarter results for the 2023 financial year, and they have net revenue of 455.6 million, which was a decrease of 22% year over year. Their active clients dropped 11% to 3.7 million. The net revenue per active client was flat at $525, which is actually quite high, actually. They had a net loss of 55.9 million and a diluted loss of 50 million. And their adjusted EBITDA loss improves it from 55 million to 7.4 million. It's really interesting. Well, I thought it was quite interesting because the main thing they've adjusted out is stock-based compensation. I don't understand why that's adjusted out because surely they're paying that to people every single year. It doesn't seem like an exceptional item. It just seems like a way of trying to make the figures look a bit better. I wouldn't adjust stock-based compensation out, personally. I also question why they're getting so much stock-based compensation with these results. I thought this was interesting because it's a bit different to the other companies we've covered on the show where it's, you know, the growth stories. So this is actually trading at a market cap of 400 million. And this was, so it's at $3.95 a share. And at the high, it was at $95 a share. So this is down about 97%. I think these results suggest why. It's losing a lot of money. It's losing customers. And I don't think, based on having spent quite a bit of time looking at Boohoo and ASOS, that its business model is the most sustainable. I mean, say what you like about the Boohoo and ASOS. Does Eleanor order from Boohoo and ASOS?
She has done in the past.
When they send you something, would they give you a prepaid label to return it?
I think they used to, but they've changed the policies now.
Well, yeah, quite right too. I think if you're going to return, like it just doesn't sound very sustainable.
She said, I think she said something along the lines of she wouldn't shop with them again since they changed that policy. But she went and she bought one of the brands that Boohoo own, but that was unbeknowingly, and she liked the product.
Oh, right. So
it might be an image problem with Boohoo now. I don't know.
Yeah, I mean, my sisters use it, and I was with my sisters a couple of months ago, and one of them basically had a dress they'd bought, and they were going to just return it. They tried it on and didn't like it, and it's just, I think that's pretty classic. Fortunately, the other sister liked it, so it ended up getting passed from one to the other. But at least they now have maybe I'm wrong, so if I am, tell me, but at least they now, I like to think they have the confidence to hope you're going to want to keep the item rather than send you don't make it easier to return. I just thought it was a bit interesting because normally we do have quite good companies on for the US company, even if they are a little pricey, but these results are just awful. I don't think it's a very good business model. And I just thought it was quite interesting because it's a stock that used to be quite popular on like Twitter and stuff. And I just thought it was a good example that if you see a business and you're just getting these red flags, just stop. Because for me, I know I've not talked about it for very long, but there's just no need to look any further. It just looks bad. So I know I've led the witness. Oh, it also obviously doesn't have a PE ratio because there's no profits. So with that in mind, John, do you have any further thoughts?
I think fundamentally flawed. It might be a bit of fun to try out, but I certainly wouldn't be using it regularly, and I wouldn't be buying stock for sure.
No. So in that case, of the 6 companies we've covered this week, British American Tobacco, Supreme, AJ Bell, Mind Gym, easyJet, and Stitch Fix. Ethics aside, if you had to buy one, which one would it be?
It's a bit tricky, actually, Sam. I would probably go for Sam. not left with a good option here.
But you get this question every week. You must have been expecting it.
I know, but I usually have one that I would obviously gravitate towards. I'll go for AJ Bell. Maybe I'm wrong about the industry, and maybe I'm wrong about the growth prospects. What about you?
Is that an ethical thing?
Yeah, I think that way. I think I couldn't.
All right. So if smoking didn't kill people, but
Sam,
Brat was the same business.
we're not going there. We're not
Right.
going
Okay.
there.
I can't make. So I think we know what you would have said. Right. Okay. Well, mine would be Supreme. Obviously, it's the only one that I own. If it weren't
Right.
Supreme, it would be British American, for the reasons that I've outlined.
Okay. Well, thank you very much for listening, and see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.